Gold is breaking out to new all-time highs, now above $3,300 an ounce. Since the start of 2025, it's gained more than 30%, while the Standard & Poor's 500 is barely up 2% year to date. But at Blueon Financial Analysis, we believe the real opportunity isn't just in the metal itself, it's in the miners. After more than a decade of underperformance, we think gold mining stocks are positioning to outperform gold in the next leg of this cycle. But first, let's understand why gold is outperforming. Take a look at this chart. It shows global central bank gold reserves since 1969. What stands out? Since the 2008 financial crisis, central banks have been consistently buying gold. That trend hasn't just continued, it has accelerated. Today, those reserves are back to levels we haven't seen since 1969. In fact, gold just overtook the euro as the second largest reserve holding in the world since the end of last year. Why? Because fiat trust is eroding, inflation isn't dead, and sovereign debt is spiralling. And yet, while demand is surging, production isn't. As we can see in this chart, global gold output has flatlined for the better part of a decade. This isn't a temporary dip, it's a structural squeeze. The world wants more gold, but the miners aren't delivering more supply. You don't need a PhD in economics to get this. When demand rises and supply stays flat, gold prices tend to go up. And if prices go up while a miner's cost base stays relatively stable, that's margin expansion, bigger revenue, higher profitability, and potentially higher share prices. Now, gold miners have lagged badly compared to gold prices. Just look at the GDX to gold ratio. This compares the performance of gold mining stocks represented by the GDX ETF to the price of gold itself. When the ratio is falling, miners are underperforming gold. When it rises, they're outperforming. And for the last 13 years, it's been in a steady decline. But now, that might be changing. This chart is testing a major multi-year breakout level. Since 2007, it has tested this downtrend line not once, not 3, not even 4 times. This is the 5th attempt. And as technical analysts often say, the more a trend line is tested, the more likely it is to break. If that breakout holds, it could signal a shift. The miners beginning to outperform the metal. That setup is compelling. Prices have been suppressed, valuations remain compressed, and if gold keeps moving higher, miners could offer significant upside. Consider this too, the average break-even level for gold miners, what it costs them to operate and stay in business, sits between $1,250 and $1,600 per ounce. This is often called the all-in sustaining cost, which includes everything from mining and refining to maintaining operations. With gold now above $3,300, many producers are earning margins of $1,700 or more per ounce. And if the bullish case for gold continues to play out, with persistent inflation, monetary easing, and geopolitical tailwinds, those margins could expand even further, offering not just stability, but outsized profitability. So where does that leave us? Central banks are buying, supply is tight, and the miners, still priced for underperformance against gold. That's where asymmetry lives. No hype here, just a macro-driven setup that deserves attention. Gold's moment is here, the miners could be next. Make sure you don't miss it. Subscribe to Blueon Financial Analysis for sharp macro insights you won't find on the mainstream.